Hello, everybody, and welcome back to the Open Interest YouTube channel. I'm Mike Coe. Please remember, if you like this type of content and want to be alerted when we release new videos, be sure to like, subscribe, and hit that notification bell. Also, feel free to send us your thoughts or questions either in the comment section below or by sending me a tweet at Michael_Coe. Equities opened higher but reversed course almost immediately, reversing not just today's gains but yesterday's too. Certainly one of the causes, once again, rising rates. The 10-year rate rose almost 13 basis points to 2.8275%. And looking at tick-by-tick data, it was rates that led the way, if only by a few minutes. Of course, we've been highlighting the bond bears' participation in the options markets since the Olympics, but a story today in Bloomberg highlights just how pronounced and unusual the bond rout is. In the past half century, there have been only two bigger rolling 4-month declines than the current one. In 1980, when Paul Volcker was fighting one of the worst bouts of inflation in U.S. history, and the credit crisis after Lehman defaulted in 2008. Given steep declines, some traders and investors may be thinking of buying the dip, a strategy that has worked since the Volcker era. Rates peaked in late 1981, but for those viewers tempted to do that, I would like to remind you of two things. First, at roughly 2.83%, 10-year rates are lower than at any time prior to the 2008 credit crisis and the unprecedented policy responses to that and the pandemic. Second, the sensitivity of bond prices to rate changes is non-linear, and that convexity is greater when rates are lower. Put simply, an increase in rates from 3% to 4%, all else equal, will hit bonds more severely than an increase from 7% to 8%. We are currently experiencing the worst inflation since Paul Volcker slammed on the brakes, but 10-year rates peaked back then 13% higher than where they close today. I'm not suggesting rates are going to return to that level, but we need to maintain some perspective on the current move. Additionally, it's worth noting that if both the bond rout worsens and equities decline much further, this begins to place significant pressures on entities which must make regular distributions to beneficiaries, such as pensions, that may depend in part on the perception of prosperity by contributors, such as endowments, because asset prices and contributions may fall together, even as claims on those assets do not. We'll sometimes describe them as short gamma, which means that they need to sell assets to meet obligations at inopportune moments. And the more inopportune those moments are, the more of their assets they may need to sell. Bear in mind, too, that some investments within their portfolio are not as monetizable on demand as others, which in turn puts additional selling pressure on those portions of the portfolio that are. Looking at options activity within ETFs today, we saw above average options volume in several rate-sensitive areas once again. XLF traded 2.7 times average daily options volume. Although there was above average call buying there, this was largely the result of some short covering. We saw purchases of the April 29th weekly 39 and 39.5 strike calls, purchases of 75,000 and 115,000 contracts respectively, but exchange data suggests those may have been closing, profit taking, on earlier bearish bets that were initiated probably about 2 weeks ago. The sector has fallen about 3.75% since then. TLT again saw well above average volumes, nearly 250,000 puts traded, including nearly 45,000 weekly 120 puts that are expiring next Friday. TBT, the ProShares Ultra Short 20-plus year Treasury ETF, saw 3.4 times average volume. According to some exchange data, at least 40,000 contracts of that was a 10,000 lot April 22nd, May 25th strike straddle swap. Buying April, selling May. But directionally, the largest trade was a July 25, September 27 call diagonal, buying lower strike Julys. A short-term bullish bet in TBT is equivalent to a bearish bet in TLT. IYR, the real estate ETF, traded nearly 3 times average volume. Puts outpaced calls by 17 to 1. A buyer of 13,000 May 105.98 put spreads is gearing for a nearly 10% decline in just over a month. IYR is down just under 6.7% from the 2021 year-ending high and still well above the pre-pandemic highs. Technology ETF XLK traded double the average put volume. This trade was a rare sign of optimism today, a diagonal risk reversal. The trader sold 7,000 May 132 puts at $1.03 to buy 7,000 April 29th weekly 150 calls, notice that the short put strike draws a line in the sand almost exactly at the lows of May 2021. Moving on to single stock options, Elon Musk continues to drive huge volumes, not just in his car company, but Twitter. After seeing huge volumes following the announcement that he had become Twitter's largest shareholder, today Twitter was once again the options contract volume leader as the stock jumped to 48.5 on his hostile bid to buy the company before falling to $45 a share. That's below yesterday's closing price. An opening purchase of 10,000 of the October 55 calls for $3.70 was the largest institutional bet we saw today. Other than options that expired at the end of the day today, the weekly 50 strike calls expiring next week were the single most active contract. 60,000 of those traded at an average price of about $1.40. With an average trade size of just 5 contracts, though, much of that activity is likely retail. Wells Fargo reported earnings. Street clearly not liking what they heard. Stock fell over 4.5% today. Although options traders in the name appeared to be looking at the dip as an opportunity to play for a near-term bounce. Bullish bets exceeded bearish ones, and the options seeing the largest opening activity were next week's expiring April 22nd weekly 46 strike calls. Many of those trades are probably in the green already, considering much of that activity occurred shortly after the open, while Wells Fargo was still trading around 45.5. It closed at 46.31. Miami-based oncology and urology biotech company Vero traded 8 times average daily options volume and rallied 4.2%. This stock has more than tripled since last Friday. The company held an investor conference call earlier on Monday, providing an update on Zabizabulin. I encourage those interested to go to the company's investor relations website and replay their webcast to get more detail. But the short version is that this dual-purpose cancer treatment and antiviral saw significant positive outcomes in trials as a treatment for COVID. Stock price since tells you all you need to know about how investors view the implications for Vero. Taiwan Semi reported earnings. Stock fell 3.1% and traded double the average options volume. Short-dated upside call selling and put purchases suggest many options traders feel the weakness could persist through the end of the month. We've discussed that Taiwan Semi is a big supplier to Apple, which represents nearly 26% of the company's revenues. And they themselves discussed weakening demand following Apple's announcement that they were going to cut production of the iPhone SE. Taiwan Semi has sold off significantly since then, and I'm assuming that some investors must have been hoping that the company was trying to preemptively lower the bar into earnings. In fairness, it should be said that the NASDAQ 100 overall was down 2.3% today, so on a relative basis, TSM's decline isn't quite as poor as the headline might suggest. Okay, so let's take a look at a couple viewer questions. Beat COVID-19 asks, hey Mike, what is a reasonable option strategy if I think Twitter will trade between 35 and 55 near term? Okay, so short strangles, I suppose. The August 40-50 strangle, so selling the 40 strike put, selling the 50 strike call, that closed around 680 or so. So the break evens on that trade would be 38.20 on the downside and 56.80 on the upside. And you'd profit $6.80 a share if Twitter is between 40 and 50 as of August expiration. That wouldn't be a trade I'd recommend for the faint-hearted, though. Risk-taking speculators only for that one, since that risks getting short the stock at 50. It would be net 56.80 when you consider the premium you're collecting. And while that may seem considerably higher than where the stock is now, and it is higher than Elon's best and final offer, which works out to just under $55 a share, it's worth noting that those levels themselves are well below the one-year high of nearly $72 a share. We're certainly in a different world now, but how the board responds to all of this remains to be seen. Personally, I wonder if they might have a hard time approving a sale at a discount of over 20% to levels where the stock was trading within the past year. And also, don't forget that we saw institutional buyers of those October 55. So there are some people who are thinking that we may get a higher bid. So the range-bound thesis, maybe consider selling the downside puts, but not the upside calls. Just 2 thoughts off the cuff. Okay, So M. McCann asks, what percentage of a portfolio should you allocate to a single trade, i.e. a debit or credit spread, margin risk for the credit spread? Additionally, when a trade moves your way, do you press your position, i.e. buy more, or do you just roll your position forward? Thanks. Okay, so first of all, with respect to sizing, I actually discussed this a little bit on the video yesterday. Some people are comfortable taking more concentrated positions in single names. For some, that might be 5%, 7.5%, even as much as 10% of a portfolio. I would say that 10% of a portfolio allocated to any given single stock is pretty concentrated. It's the first thing I would say. Now, of course, when we think about how much we're allocating, we're usually thinking about it in equity terms. So usually when I'm first entering into an options position, I think about how much of the stock I would buy or sell, and then trade options on that number of shares. Now, to your point, if you're using a credit spread or a debit spread, these are trades that limit the total amount of risk. So one of the reasons when you're taking a position that you limit the amount of exposure you have to any single name is that if the stock, for example, goes to zero, you can live through the loss. If you are doing a credit spread, it is possible to consider doing options on slightly more shares than you might otherwise have purchased. And the reason is because your worst case loss would actually be lower. The important thing to point out, though, is that worst case loss, generally speaking, with a credit spread, is going to occur in a realm that's closer to the current stock price. So you're kind of measuring those two things against each other. In general, I will sometimes use options trades that might ultimately, when I'm using spreads like that, be double what I would otherwise trade with the equity position. But I usually size my options trades around what I would consider reasonable for options. And by the way, it's not uncommon for my options positions to actually be smaller. So, for example, I have a position in Halliburton. I'm short some calls against that Halliburton position, but not against every share that I own. I'm also short some puts at levels where I'd be comfortable purchasing more of it. But again, not the same amount as the stock that I currently hold. The second part of your question is, do I, press, roll, or adjust? Again, because a lot of my options positions are in addition to core holdings in the equity. Usually it's an adjustment. Today was expiration. I had some Halliburton short calls that were expiring. They were at or just in the money. I rolled those out in a like quantity to a slightly higher strike for just a little bit more premium than the ones I was repurchasing. A lot of these types of things are going to be case specific. It's going to be case specific to you, case specific to the individual security. So these are just sort of guidelines, but I hope you find that helpful. I'm Mike Coe. That's all I have time for you all on today's segment. Again, please be sure to like, subscribe, ring that bell for notifications when we produce more videos like this one, and feel free to share your comments or questions, and enjoy the long weekend. Thanks for watching. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_Co, or go to our website, www.openinterest.pro. Thanks for watching.